Kelly, thanks. Fed Chairman Jay Powell, in the first 2 days of his testimony on the Hill, acknowledged the better data, including the retail sales report and that May employment report that surprised to the upside. But as you said, he continued to express concern about the uncertainty that's out there, including concern about a second wave of the virus and a long recovery in which millions may still find trouble getting back to work.
A large number of people will not be able to immediately go back to work at their old job or even in their old industry. There'll be a significant group that's left over even after we get the employment bounce. I do think, they'll be hard pressed to find work, and they're going to need support. They'll have regular way state unemployment insurance for a period, but that's something I would be looking at, is what kind of support will they need?
Powell did suggest that under some circumstances they could stop or halt those purchases they're making and lending, but that was not the operative idea that he was suggesting. He's really suggested unwavering support of the Fed in providing loans and making asset purchase. He urged Congress to do more as well. Some concern from senators about the Fed doing too much and how it would run off its growing balance sheet. And Powell also talked about his concern about the Federal Reserve distorting the corporate bond market.
I don't see us as wanting to run through the bond market like an elephant, doing things and snuffing out price signals and things like that. We want to be there if things turn bad in the economy.
Kelly, what we don't know is what would turn off these programs the Federal Reserve has. We know what's turned them on. That's the coronavirus. That's the negative numbers we've had on the economy. But it's unclear whether the Fed or what construct or what tests the Federal Reserve would use to either slow them or stop them.
And Steve, we also spoke with Vanguard's chief economist yesterday on this notion that maybe the next fiscal package should include some kind of automatic stabilizers. In other words, if the unemployment rate doesn't fall fast enough, then you could do more extended measures to support people who are jobless or whatever form that would take. And then if the unemployment rate is better than expected, some of those extra benefits would fall off more quickly. It's an interesting concept. I don't know if there's any chance it becomes reality.
Well, I think it's emblematic of the idea the Fed went in with both feet, and there was a hue and a cry from all over the country, including politicians, for the Fed to do as much as it could, as quickly as it could. And it did not embed necessarily in all of the programs. In some of them there are, but it did not embed in all the programs any way for it to shut them off. For example, if markets were to be functioning better, the Fed is not lending above market, for example, or not buying corporate bonds above the market price. It's buying bonds at the market price, and then it's obviously lower than themselves. So this whole bond market question about how it gets in, how it gets out, and what triggers either is unclear, and it's something the Fed going to have to deal with a little bit more, as some of these questions from congressmen may be on the increase.
Yeah, and even if they're buying at the market price, it's only there because of the Fed support in the first place. Exactly. I understand.